Hey guys, welcome back. So now I want to talk about gaps. Now, to me, gaps offer a very, very good opportunity. Now, specifically, if you're a trader who's very time poor, in other words, you've got other commitments, you don't want to be sitting in front of the screen, and you also don't really want to be swing trading. You want to be day trading, but you want to be trading when there's opportunity, in and out, take your profits, make your trades, come out, reassess the next opportunity you get to come into the market, as opposed to a swing trader which will hold it for a longer period of time, or a truly focused day trader who may sit there all day long. So, and also actually, if you are a swing trader, gaps can offer you an opportunity to get involved in something that may well run for several days, if not several weeks. So they really are a good thing that you should focus on as a trader. Now, you've got a couple of different types of gaps. I'm going to get a drawing pen out here and kind of visualize this a second. You might have to forgive my freehand drawing with the mouse, but I kind of guess that you guys will know what we're talking about. So imagine that there's your candle there, and you know what we'll do is we'll color that one in green. Again, a little bit scruffy, but you get the idea. So a green candle on the day indicating that's the open of the day, that's the close of the day. There's your high, there's your open, there's your close, there's your high, there's your low. Standard stuff, really. And now you've got two types of gaps. Let's assume this is the candle we're talking about. So the next day we get this scenario where the price opens here. Now that is a much more significant gap, because that is gapping out of the prior day's range. If that was the high of the day and the low of the day, there's a range of the day. If that's the open of day two, then that's much more significant than if we gapped here, which would still be a gap because there's your closing price here, here's your opening price here. So that here is still a gap down, but it's nowhere near as significant as a gap that is gapping out of the range. And then if you can extrapolate that further out and say, well, if we gap out of multiple days ranges, then we're really talking something interesting. If it's the 4 or 5 days range, a monthly range, a weekly range, and you're gapping out of it. Because if you think of it from perspective of traders, the more the gap is taking out, or more ranges of days, should I say, that's not really quite the right way of putting it, but you get the idea. The more days that we've gapped out of, the more people are going to want to be involved, or are going to be trapped, or are going to be more inclined to take a position or unwind a position because they're either hurting or they perceive it as value or whatever it may be. And for us as traders, the more participants in the market, generally speaking, the better. Okay, it can swing aggressively one way and be really, really volatile, which just becomes a little bit too much. But generally speaking, nice bit of volatility, nice bit of volume, a nice lot of participants involved in the market is better for us as traders. So today, actually, great example for gaps. Couldn't have been better for this video. Let's have a look at the Dow Cash. Now, I'm going to flick back in a minute to the S&P 500 ETF, because obviously if we're using a CFD for the Dow Cash, that's going to be all the overnight session as well. So we're not going to be able to visualize and see where the gap is, as we can see on this chart here, which is kind of a synthetic Dow Cash price that most CFD cash providers will quote. It's not showing a gap, but technically speaking, we have gapped, because the regular trading hours at 2:30 UK time to 9 o'clock UK time is when all the magic happens, when all the stocks are open, when in reality, that's the index price. We've got the futures trading overnight, which is obviously affecting this synthetic cash price they're making, but it's difficult for us to visualize it. So I'm going to switch back to the S&P 500 ETF purely so we can visualize it on the chart. If you were trading the Dow Cash via a CFD, or the S&P 500 via a CFD, then obviously you could do that, but you just have to visualize it differently by adjusting your charts to suit. So let's have a look and see exactly what's happened with this scenario. So we've gapped out, and again, the more powerful gap, we've gapped significantly lower. We've gapped out the prior day's range, and the day before that. So 2 or 3 days range is not quite this range, but it's significant. A lot of people are interested. And if we flick over to a 15-minute, we're going to see exactly the kind of depth of the gap, how deep the gap is, and significant the gap is. Now, putting this into perspective, guys, what I'm going to do also is talk about today as an example, and also the different ways we can trade the gaps, different types of gaps. Depending on when you're watching this, of course, we are in the top of a bull market. Not necessarily this is not necessarily the top. I'm not calling this as the top and this is the turn. What I'm saying is we are in a bull market and we are at highs, pretty much as is standard for most bull markets. You spend time at highs, and we're just coming off those highs. So that's a lot different from a scenario where we were in a bear market and we had gapped up. We're actually in a bull market and we've gapped down. So you've got to kind of put that into perspective. We'll talk about that more in a second. But before we move on, let's look at the different types of ways we can trade gaps. We've got two ways we can trade gaps. We can ultimately trade with the trend, looking for a continuation. So if we've got the close here and we gap lower, we can look for short opportunities. In other words, we think the gap has got more to run. Perhaps people are trapped long, perhaps it's caught people out. Whatever reason, we're looking for short opportunities. The flip side of that is we can try and fade the gap. So a lot of people will trade this, and then this is actually quite a common way of trading. And yes, it is a good trade, but you have to look at them each independently and weigh up the odds of the trade being successful based on different parameters, which we'll go through. And the idea of that is you're looking to fade the gap. So if we've got a gap lower, we're looking to buy it, go long for a gap fill, and we're trading for a gap fill, or we're trading for half a gap fill, or whatever it may be. So let's look at it in a second at some more actual examples and some of the setups we can use to trade the gap, and also look at what's happened today.